Our next guest says you can trust this bounce. And in fact, we are in for a big summer rally. Let's bring in Bartels, head of ETF strategy at Bank of America Merrill Lynch. Marianne, great to have you with us here on set.
Thank you to have me.
You've heard the preponderance of cynicism when it comes to this bounce. Why do you think we're going to see a summer rally?
Because the underlying data, which we're not really talking about, is really strong. We just finished up earnings, and towards the end of the year and the beginning of the year, everybody thought we were going to have an earnings recession. Earnings beat expectations by 5%. We're up 2.5% year on year. First quarter GDP around the world actually surprised. Employment is still strong. Productivity numbers are starting to improve. We haven't seen productivity strong in a while. We've got a couple of good data points, and if that trend continues, that's also going to be good for the economy. So we're starting to see a lot of green shoots that the market's really not paying attention to with the trade war noise that we're seeing.
For the earnings in particular, I'm curious because some people will say, oh, the first quarter, that's rearview mirror at this point. When it comes to the full year forecast that we've had, do you get a sense that companies have already factored in the full impact of a full-blown trade war in those forecasts, or is there room for a ratcheting lower of those full year forecasts?
Well, the way we try to measure that, one of the greatest leading indicators of the direction of earnings is looking at earnings estimate revision ratios. What are analysts really doing with their numbers? Because they're the ones that are really talking to management. And we're starting to see a trough on a global basis in earnings estimate revisions. This is another one of the green shoots that we're actually talking about. So we think there's actually potential upside surprises as we move forward.
Marianne, if that's the backdrop of cyclical green shoots, what type of stocks or groups do we need to tell us that story from the market perspective?
So everything that just got hit is everything that you want to buy. So we actually did some interesting analysis because we follow ETFs, and we wanted to see what ETFs were highly sensitive to the China trade war, and the majority of them are technology. Particularly semiconductors, and then you got the QQQs in there. And so tech is getting hit pretty hard, but that's a sector that we see secular growth in. In fact, we think that's part of the driver of the secular bull market. So tech would be number one. We still like consumer discretionary and industrial. So we would stay with the cyclical side.
You know, your firm just released the fund manager survey, and in that fund manager survey, it is perceived that technology is the most crowded trade out there. And so how do you reconcile because that implies maybe people are getting it wrong and they're getting too ebullient about that.
It's a really great point. Basically, maybe you have overbought conditions, and Chris knows this a lot better than I do, is you can get some overbought conditions, and you have to correct out some of these overbought conditions. But when you take a much longer term view of the position of technology, particularly the technology here in the United States, we're very, very well positioned. And I think that this is the main driver of the market. So clients that have been concerned about actually putting money to work, this is their opportunity. They had it in December and January. If they still haven't come in, this is another opportunity for them to add to equity exposure.
So, Marianne, what's the bear case? China, U.S.-China side, what's the bear case? What sort of shoots a hole in this, your 2,900 price target?
So we highlight three different scenarios, and the worst scenario is an outright trade war where we just get a lot of tariffs upon tariffs and economic data starts getting impacted, and that starts implicating earnings to the downside. In that particular scenario, then we see a potential 20 to 30% downside. But here's an interesting statistic. We looked at all the different secular bull markets. And since we had a bear market last year, we wanted to know if we've ever had consecutive bear markets in a secular bull market. And the answer is no. We've never seen back-to-back bear markets. And I think that's
unless you're in a bear market.
Well, unless you're in a bear market, but that, yes, absolutely. This is in a secular bull market. So we already had the bear market, and I feel that many clients aren't even focused that the bear market happened, and now they have opportunity because between Brexit and trade wars, it's really taken away from the underlying data. Given everything that's happened, the data actually really has a positive tone to it.
So when you say summer rally, what kind of rally are we talking about?
Well, see, now this gets exciting. If we can really get some good quiet and a really good rally, we can break out to new highs, and we can get up into a range of about 3,000 to 3,200
by the summer.
By the summer,
3,000 to 3,200.
Yeah, because the market's not positioned for that. But our year-end target still remains 2,900. So we don't see that actually sustaining throughout the year, but we do think that we can get a very, very strong summer rally.
Marion, does that rally start here, or does it start at 2750, or does it start at 2600? I think that's the tricky part of the call here. We're 4% down. Is that enough in this tactical drawdown?
And I think that's the right question, because we can get 3-5% corrections within a year or a 10% correction. One can argue you've got the 5% correction. The question is, do we go down to 2650 and kind of get that, full 10% correction? Really, nobody really knows the answer to that. So it's going to be between here or 2650 that we think the market settles out and then really starts the summer rally.
All right, Marianne, thank you. Good to see you. Marianne Bartels of Bank of America Merrill Lynch. That lines up with what? With your newfound bullishness, Grasso.
With my newfound bullishness. I think that when you go back, think about how many headlines on Brexit sent the market into a tailspin, right? Now you see Brexit, everyone just totally ignores it. Now, I'm not saying that China trade is going to be the same way, but to the same degree, no. But by the same extent, maybe it is sort of getting numb to it with the market overall.
Great to have Marianne here. Great to have Bank of America on our desk. And I would just say the pushback I would have is that, first of all, mega cap tech has always been defensive during these periods where people have questioned growth. The problem is the epicenter of this storm is technology, right? And think of the American companies that say China is not their friend right now and they're running into it. Think of what Intel told us twice. Think of what Texan told us. So in an environment where I think you've got this could feel a little bit different, plus regulatory overhang. As much as I love Google and Facebook and Apple, these companies may have a slightly different cycle to ride through right now than they have at other times when we've questioned global macro. That's just a thought.